Welcome to this week's Market Commentator podcast, Moneyweb's series of interviews with investment professionals. Chief Investment Officer at Imara, Bruce Williamson, joins us this week. Bruce, thanks for your time. It's good to have you with us. Now, you are in charge of Imara's Resources Fund, alongside being the CIO. That has got to be a tough place at the moment, resources.
Well, it's not only at the moment, Hannah. The resource market, after recovering in 2008, peaked in May 2011, and since then it's been initially steadily downhill, and then in the last 12 months there's been some really bloodletting days with a lot of negativeness. Absolutely,
we've seen a huge amount of pressure on many resource stocks. Do you still see opportunity in this sector?
Yeah, we're still pretty bearish. We're concerned that the world is relying and hoping that China carries us through. I mean, frankly, China probably accounts for 50% either side of most seaborne traded commodities. And, it's well documented that China is now moving a bit away from their investment infrastructure philosophy, and they're moving more into consumption. And with that, there's just been a tick down. And we over-reliant on China, and especially if you look at the steel sector, it's really, really tough, despite the massive fall in coking coal and iron ore, which are big inputs from there. So despite that, the steel sector is battling. It needs a lot of restructuring. That cannot happen overnight. So we still see a really tough few months ahead of us.
How long do you expect this to last? You talk about a few months, the commodity cycle downturn. As you say, commodity prices have been coming under pressure. Resources have been coming under pressure for years. What are the numbers telling us? Are we going to see, we hear about pullback in production from various producers, whether it be oil, iron ore. Are we going to see the numbers turn and demand coming back online?
You're certainly not going to wake up tomorrow where demand sufficiently exceeds supply to now turn this market with confidence. So we've always believed that you need to tighten the market, and that means producers have got to cut back, and or people have just got to go out of business. Now, one of the things that has happened, which certainly didn't happen 20, 30 years ago, is banks and private equity and venture funds have got into funding mining, as have the offtake guys. They will come in and provide some funding. So there's this artificial and not very clever in many instances way of keeping companies alive. And at risk is that the shareholders get left aside, because once you bring debt in, the company goes to the wall, suddenly they claim your assets or your shares. And that, I think, is stalling the cleaning out of the commodities market. You see the big fight going on in iron ore. Rio Tinto and Billiton are able to get their costs down lower and lower and lower. And people like Fortescue, fourth biggest producer in the world at about 150 million tons, complaining bitterly that the bigger guys should be cutting. That's not going to happen. Really, to turn this market around, you've got to cut supply. Lower prices will bring on a turn eventually, but we need to cut supply. And so I just keep on looking a few months ahead. I can't look too much further than that. So as long as we've got a couple of months to make decisions, we're happy.
Let's talk about those decisions that you are making as an investor in resources. How are you positioning this fund? What positions are you taking and not taking?
All right, so on the Imara African Resource Fund, I've been pretty limited because we battled to raise money, and certainly when the crash came or when the downturn came in May 2011. So we've just, shareholders have kind of wanted us to be reasonably fully invested. So I've had between 4 and maybe 10% cash at any point in time. But the mandate was to be fully invested. So we literally had to ride out the downturn, which has been very tough. So I've had a couple of casualties, 2 or 3. But yeah, so the fund is down about 40% from where we started in 2009. But having said that, there's a lot of those smaller junior players that don't exist anymore. So i.e. that's 100% down. So, I am positioning their stocks like Pan African Resources here locally. That's one of my big holdings in the African fund. Nevsun, which is it was a gold, it's now a copper producer up in Eritrea. Tiger Resources in DRC, First Quantum, Zimplats. Those are the type of stocks. And then we've got we've got some Assor, a little bit of Kumba. But really, it's hold on tight. We're just saying to the investors that are in there, we've warned them that potentially this year is still going to be very difficult.
Let's talk about mining. You've followed mining very closely for many, many years. If you were a mine boss over this time, over these probably more than 20 years, 30 years that you've followed the mining sector, what might you have done differently?
And I think, there's two things that have transpired. One is certainly in our deep, narrow seam ore bodies. That's mainly gold, platinum, and to a degree chrome. I don't think we embraced technology consistently enough. We should not have let things run away where, particularly in the stoping horizons and the stoping operations, we have relied pretty much on traditional low-cost labour model. And I think the type of boring equipment that we were using in the 70s on flat development ends and box holes, etc., we should have persisted with that. AngloGold are doing that now, but there's a good 20, 25-year gap. So that is one. I don't think we continue to embrace and force technology into the stoping environment. And then the other one, which was a particularly difficult one, we built the South African industry on migrant labour, which meant big male-only hostels, compounds as they called them in the old days. And I think we've battled in getting rid of that and moving labour into suitable accommodation. And what happened at Marikana is just you could see it coming. It was going to happen, and I don't think that in the end of the day was particularly well handled.
Investing in Africa is Imara's payoff line, more broadly, if you will. How does that really inform Imara's investment philosophy? You have a lot of funds that are focused on very specific African countries and stock exchanges, and of course some funds with a local focus. But why is Imara bullish on Africa?
Yeah, I think Adam Fleming was the one who started Imara back in 2003, took a lot of businesses that were much older, that had been in place for many years, created Imara, and today we've got a General African Opportunities Fund, that's ex-South Africa, a Nigerian fund, an East African fund, a Zimbabwe fund, and then the Resource Fund. That is outside of the local South African Imara Equity Fund. And really, it was lessons learned to some of my colleagues that had worked in the UK and gone to Asia 20, 25 years ago when no one else would go there. And they saw what happened. And so with Adam's support, that was what we chose to do in 2003, and we have built up. You've got to be patient. The markets are illiquid. They're starting to develop now. And you're going to make a call. Is Africa going to fall back into one big hole? And it's highly unlikely. There's just too many opportunities there. And Africa's too connected now to the world. It's not out of touch. It's in fact more and more in touch. So burgeoning population, young population, mobile technology is already making a massive difference in people's lives. And so all of that spells urbanization, education, and you become part of the big world economy.
Locally, you mentioned to me earlier that Imara is a little bit nervous on retail stocks. Why is that?
Yeah, earlier last year we sold out of some of them, and then more recently we've been watching. One of the things we've been watching is, and trying to gauge over the last sort of 5 to 10 years, is the impact that government and state-owned enterprise packages and salaries, what that has done. And it created a middle class of substantial buying power. And we'd been watching that, and we believed that had contributed to the good results of a lot of retailers. And then just being aware that we didn't think that could continue. So just as recently as these last few days, we've trimmed back on things like Mr. Price and Woolworths a little bit. So we were not aggressive, but we had good solid holdings in those type of stocks. We didn't bail out early, and now we're just watching what's happening with the wage negotiations from here on out. So we just prefer to trim those sort of holdings back.
We hear a lot about the fact that our market is overvalued, is expensive, running at a historically high PE. Where are the opportunities in South Africa on the all-share index?
Yeah, that's a tough one, because I think we probably in line with a lot of people is that we're tending to be defensive now. So it's a case of watch out for losers. At the end of the day, it's much like golf, is don't hit bad shots, you'll have a good round. And, that's been our sort of attitude at the moment. So we don't see out and out winners and saying, wow, things are ridiculously cheap. It's looking more to defend for the time being.
Avoid the losers. What, in Imara's view, are the major drivers of markets at the moment, whether that be here in South Africa or globally?
Well, a key issue is the dollar and US interest rates. You look at that long-term trend since 1980. US rates have come from 18% in the early 80s down to pathetically low levels now. And with that, the equity discount rates have come down, and that's obviously a substantial kicker for equity. So you've got to bear that in mind, is what are the Fed going to do next? Because if that strengthens, if interest rates move back up, that's going to alone impact on valuations. The other side of that coin is the rand. So if they did push interest rates, which we don't think that's going to happen, that'll happen later, not sooner. But if that did happen, the rand would weaken. And sadly, all our traditional old mining rand hedges are not in a position to benefit like they used to. So we would be cautious on that. But I mean, the key thing with South Africa is that we've got tremendous corporates that since 1998, when the stock market was opened and foreigners came in, with that they took a lot of our corporates offshore. So now for 17 odd years, our corporates have been going offshore, and the businesses are extensively diversified. So we kind of well covered. South Africa is better weathered than people to handle the storm than people think.
I'm surprised to hear that, because often I interviewed an asset manager last week who said that it's 100% invested in global and offshore equities. Very hesitant on the local market, not necessarily saying there'd be a correction, but just saying that the valuations are extremely stretched here in South Africa, and offshore is a much safer place to be in terms of global equities. Do you support that view?
They're probably alluding to Europe, which has been through a torrid time, and there's companies there that have been in for hundreds of years. So I guess they're right in saying that, but whether you would take all your money out here and put it in there, I mean, tactically you can take 20-25% out here. But yeah, maybe people have got full discretion to do what they like, could remove their money here and go and play in the European market, which looks as though it's starting to see some daylight and moving forward. But what I'm saying is that if things didn't go too well here, is remember that a lot of the equities here are positioned globally. So it's not just South Africa that they rely on.
Finally, Bruce, should investors expect more volatility this year than in previous years, and hold tight, as you alluded to earlier?
Yeah, I think, look, equities, I find it strange that nowadays, and it's maybe because we've got a lot of additional players and hedge funds and all these big pools of traders, that you can get 1, 2, 3, 4, 5% swings in a day. If you looked at conventional valuations, you wouldn't think that you could get such big swings in a day, but you do. And we know that's these pools of other players that come in and out on a daily, on a maybe a half-hour basis. What we're saying to our investors is we're not quite going to see the growth in earnings that we saw last year and the year before, be prepared to accept lower. And yeah, we're not scared of a big fall right now, but it is something that you've got to keep watching. When you have the extended valuations, you could see everyone just bail out at the same time. But we're not seeing that happening, but we are on the defensive tact.
Bruce Williamson is the Chief Investment Officer at Imara.